So listen, thank you everyone for joining us this afternoon for our Dublin BIC Ask the Investor call. You're all very welcome, and we're delighted to have Dr. Helen McBreen of Atlantic Bridge Ventures with us here this afternoon for about the next 50 to 55 minutes. And Helen, thank you for your time. And maybe tell us a little bit about you to get us started. How did you find yourself into the world of venture funding?
Hi, everybody. Thanks, Connor, for inviting me today. So I joined Atlantic Bridge in 2015. So it's been a very fast number of years here at the firm. I joined, and that was my first introduction into VC, actually joining Atlantic Bridge, having previously worked at an accelerator, and prior to that, working as an engineer. I'm an electronic engineer and did a PhD at the University of Edinburgh in the area of conversational AI, which was about 20 years ago, actually, which is hard to believe that some of those technologies are in market now, which shows the length of time it can take to get deep technologies into market. But my career has been very much with early stage technology companies, having worked in a number of positions with early stage companies on the product side before moving into more commercial roles, then working with early stage startups in an accelerator, and joining Atlantic Bridge, as I said, in 2015 to manage the university fund, which I'm sure we'll go into in a little bit more detail throughout this conversation.
Very good. And if I did my stalking right, you actually had an exit along the way with a startup, CellTrack. You were involved there, and that successfully exited?
Yes, that's correct. That was a number of years ago. So I worked as sales director for CellTrack back in the mid-2000s, based in Galway. CellTrack was a spin-out company from an electronics engineering firm based in Tuam, which is actually a family business. Still going today, acquired by Valeo, over 1,000 people employed in the west of Ireland in that firm, working on cutting edge computer visioning technologies. And CellTrack spin out in the telematics space and the telecommunication space as well. Yeah. Very
good. So you've seen it from both the startup side, you've built the business, you've exited, and now you've seen it from the venture side. So you're ideally placed to kind of guide us on this journey that for lots of us we're going through at the moment. So thank you for that. Maybe tell us a little bit about Atlantic Bridge, because I think most of us would know about the university fund, but there's a lot more to it than that. You have €1 billion in assets, you have our offices around the world, you have a bunch of people. Maybe set out the scene of what it is exactly that you do and who you are.
So we have 8 funds under management here at Atlantic Bridge, and we invest from seed right through to growth. The firm was founded in the early 2000s by some very successful technology entrepreneurs who had built a number of companies, including Parthis, which was in the semiconductor space, a very well-known story, and the company would have IPO'd back in the early 2000s. And the firm went on, I suppose, to raise cycles of funding and expand what we call the LP base, or the investor base in the funds over the last 2 decades. And we have been the backers of some of the most successful semiconductor companies in Ireland, including Decawave and Movidius, but equally in a large number of software, enterprise software companies. We're investing in Ireland, the UK, across Europe, pan-European, and also in the United States. And we have about 25 investment professionals located here where we're headquartered in Dublin, but also in London and Palo Alto, and across Europe as well. So we have, I'm certainly not alone. I have the pleasure to work with really bright and talented and experienced operators. Actually, that's what I would say, that most of the investment professionals here at the firm have come with a large degree of operating experience themselves, having worked in senior management positions in early stage companies that have scaled and grown or built their own companies. And we work in a very collegial atmosphere across our networks. And I think that's really important for the value add that we apply to the companies that we invest in.
Very good. So if I could just explore a little then, so if it's you're moving from, or you're investing across those 8 funds right from the very early stage startup, and you're staying all the way up, are there specific funds that you have that are aimed at different stages of life cycle, or are they aimed at kind of sectoral, or probably a bit of both?
The way to think about it is that our seed fund, which is called the University Fund, we're in our second cycle of that. So we're currently investing out of our second university fund. So that is a seed fund, and we're investing in a number of different sectors within that. I would say broadly the sectors that we're interested in that fund at seed are software and AI, deep tech. So that's maybe where you include things like semiconductor or robotics. And then the third sector would mainly be in life sciences or health tech. So a lot in med tech and biotech. So that's at the seed fund. In the later stage funds, we typically invest in deep tech and enterprise software. But what we're seeing now is a number of companies are applying those technologies into health as well. So I wouldn't exclude health from that. But those companies that we invest in our later stage funds have generally have had significant de-risking. They're in market, they have products, they have significant revenues, and they're looking for growth capital.
And can I press a little bit on the university fund? By its name, is it only then for companies that are coming out of university, or is it a broader church?
So we invest predominantly in the high potential startups that are coming out of research here. So high potential startups from research. So they are the spin outs of the universities and institutes of technology and research centers right across the country. We have also been able to invest in companies, what we call spin-ins, which are companies that are probably separate to that spin out categorization, but are collaborating in a very meaningful, strategic way with research, that they're located alongside researchers, they're working to commercialize intellectual property, or they've spun into universities, if you like, so that there is a strategic link there. And the ultimate goal of the university fund, whichever categorization of company, is to commercialize a very strong depth of research in the Irish economy here. So we've been investing as a state about $1 billion a year in research on average. We have very significant university research base and sector-specific research centres. And best practice across the world, both in Europe and in the US prior to it, has been to have fund managers in place alongside universities to work to derive impact into the universities from a commercialization perspective, improve the culture of entrepreneurship within in universities, but also to have an independent arm's length institutional fund manage that investment process and that investment decision process. And
so maybe you might explain, because I think we've a mix of startups on the call. We've got early stage, later stage, mid stage, we've the whole gamut here. You might just explain for me and for the audience what the spin in, spin out, just put that in context for us. What exactly does that mean?
So I think that the best way to look at it is, regardless of that categorization, if you're a company that has developed an interesting enough proposition that you feel is differentiated from something that might be already out there, is so cutting edge that hasn't been there at all, is to approach us and talk to us. Specifically, if you're looking for a value add investor that can help you kind of scale that company from a capital perspective and give you the networks that you might need from a syndicate partner perspective, and introductions to customers and so on globally. So I think that's the best way to kind of categorize it. So I wouldn't be too focused on kind of spin-outs, but the name of the fund is the University Fund, and we're primarily there to fund spin-outs from universities, of which there are a growing number of companies, and the quality of those companies is improving all the time as our infrastructure and our ecosystem across the third level landscape is improving, and with all the parts of the puzzle being put into place. But the model to allow us to invest in companies that are not on that spin-out track is interesting, because it does, if you think of certain innovation centres that are now located across the third level institute, for example, Nova UCD or the Ignite Centre in UCC, these are fantastic hubs to bring in other companies that are, if you like, locating themselves closer to the universities, because they understand that there's a depth of talent and access to research that might help them improve their product roadmap. And this fund, then being inclusive of those companies, is an interesting model to allow a higher number of companies, I suppose, achieve their capital goals.
So don't focus so much on, what am I a spin in or a spin out? Focus on, do I have a core piece of technology? Do I have a really nice piece of IP? Could this be developed? And then potentially you could help me navigate the journey is a better way to look at it. Yeah.
Exactly, Conor. Yeah.
Can I jump? We got some questions in beforehand, and there's a really interesting one here because I think it talks to this university piece. And it was and he mentioned that he's currently in the commercialization fund. He's working his way through some efficacy animal testing. He thinks he's going to be raising in 2023. And his question broadly is, what does that process look like? As you come out of the commercialization fund and as you start to think about raising money, what does that look like?
Yeah, so we track all of the projects that are in a commercialization fund. So Enterprise Ireland are a fund investor in the university fund, and also the commercialization fund, which is supported by Enterprise Ireland, is a very large source of funding within the third level system. So we track the projects through commercialization phase and give those people as much feedback as we can throughout their cycle, so that when they're hit the end of the commercialization route, that they don't fall off a cliff, that they have some kind of plan towards raising financing. And in some cases, in some of the companies that we've invested in our first fund, we made over 30 investments. Many of them were companies that had been in commercialization fund when we first met them. And we got to know the founders of those companies prior to them even becoming founders of the companies. They were just, if you like, postdoc researchers with a plan or a vision to go on a spin out track. An example of that might be a company, a UCD spin-out company called Output Sports. We had three postdocs from the Insight Centre there under Professor Brian Caulfield, who we got to know really well through their commercialization fund. These guys were, I suppose, acting like a spin-out company prior to them becoming one. And we've several examples of companies like that. So what I would say is, if you're in a commercialization fund, get your contacts in EI to make us aware of you, or contact us directly, and we'd be delighted to start to track your progress.
Superb. So an open invite there to Cormac. I'm going to take one more question because it's kind of broadly, and then I'll go back to where I was. But David, who we have known through Dublin BIC, had a question. He's involved in an early stage startup. It has significant environmental and social benefit, but they are, I suppose, not struggling, but the commercial returns are more modest. And I suppose it talks to this notion of responsible investing, where you're doing the right thing. You can make a return, but it's maybe not as big as if it was a purely commercial investment. What's your take on that?
So for us, we're an institutional fund, and we have we're operating economically, if you like, to deliver returns to our investors. So in that regard, we are less of an impact fund, but there are funds such as Social Entrepreneurs Ireland and Social Impact Fund that cater for those types of companies very well as well. So what I would say is, if you feel like that there's less of a returns profile for your company that you think may not be as attractive to a venture fund in a way that they might be able to predict returns to their investors, then you're probably not that kind of VC fit. But again, at the early stage, companies like that would be happy to take a look and give some feedback and signpost in the right way.
Very good, very good. Which probably leads us across then to, I guess, your criteria, your investment thesis, and what does that look like, and what are you looking for, and what's your exit strategies, and how will you deliver a return in your fund to your LP, I guess. So there's all of that sort of your thesis or your underlying strategy, I guess.
So I guess we're not unlike most VC firms. We'll start with what's the market opportunity, and trying to get a handle or get our predictions or our analysis working on whether there's a large market opportunity for what might be a very novel or cutting edge technology, because we are investing in the seed fund at a very, very early stage. So we're trying to make predictions around when markets might be made. A good example of that might be one of our companies is in the quantum computing space. This is a very hot area at the moment, but very, very nascent technologies within this space. And it could take many, many years in some cases for this market to really, to really develop. So we'll start with the market. At Seed, it's particularly important, and we would have a very strong bias towards team. It's important that the skill sets within the management team of an early stage company are complementary, that they're, people are committing fully to it, that they have the right set of skills to develop the business. If they don't, that they're, they tell us, and we try to help them, find the right, fill the right gaps within the management team. So team is huge for us, and we have a lot of value add to add there in terms of introducing people to, as I said, to management teams, repeat CEOs that might come in and work with academics, building out boards, advisory boards, and so on. So there's a huge value add there post us investing in a company. But prior to that, the quality of team is something that we would look strongly at. Of course, then you'd have the actual innovation itself, Conor. Is it truly innovative? Is it disruptive? Is it orders of magnitude better in solving a particular problem than current technologies? But overall, I suppose that's, most VCs might give you a similar answer, but every VC is always trying to find something that bit different, okay? That X factor, or that's something exceptional. And I think it's not one of those three things, but it's the combination of all of those kind of wrapped up in a very logical, thoughtful plan that can bring a company to a value inflection point with a particular capital envelope. So we're looking at all these things simultaneously, and taking the combination of all of those things to determine through our investment process if this is a company that we could add significant value to help it get to that point of value inflection.
Very good. It throws up for me, lovely. It throws up a couple of questions. One, I'm currently outsourcing my tech because I'm building something, and it's a general investment question. I mean, and you've probably answered it there, that if you're coming forward with a technology play, you probably can't really have the tech outsourced. Maybe in the short term to get something built and to prove a concept, but ultimately you're going to have to build out that team. Yeah,
I mean, it depends on what it is, I guess. I mean, you can outsource parts of your tech development, absolutely, but as a whole, is it something that can be protected? Is it something that can be easily replicated? If it is, then that probably there'd be additional risk there. So if it's something that can be either black boxed or something that's truly cutting edge and there's novelty within it, that and you can protect that novelty. So even if you are outsourcing part of it, and if you can still protect that part, then it would still be interesting. But I guess what we would look at is the technology easily replicated. If it is, then that would probably pose too much of a risk from an investment perspective.
Okay, and the second two pieces it adds for me, and it probably talks a little bit to Sylvan, has dropped a question into the chat box, which is around the valuation question. So, and everyone wants to jump to the valuation question, and it is around how do you protect the valuation of your business? And, how do you not end up giving away too much to your investors at the very start?
Yeah, well, look, you have to give to get, and then you have to make a determination as a founder what you're getting in return for equity financing, which is what this is all about. There's different ways in which valuations can be set. In some cases, they can be delayed altogether through the use of convertible loan notes, and in some cases, valuations are set. And the way in which we set valuations, we try to work from the end game and work backwards, and encourage the founders to do that as well, to look at what the exit route and timeline might look like, and the capital cycles it might take to get to that point, and various value inflections that you might get at those particular points. Work backwards from there and take it not just as a point in time of the valuation that's been set at the seed round. If that happens, in some cases you can get I don't want to say distorted, but sometimes just point in time conversations around that, and get too focused on that rather than looking at the overall journey and trying to align with your investors early to the full plan that you're trying to execute against.
You might build out a cap table that shows, pre-seed, seed, Series A, Series B. If we're successful, we'll build a $500 million company that will exit, and I'll retain 30% of that in 4 or 5 years' time if I'm successful. Well, that's fairly significant. What you can't do maybe is kind of say, well, I don't want to give away anything today, but you're giving away percentages of nothing really. So I love that piece of advice. And in fact, I was working with somebody recently and we had exactly that conversation and modeled it out over 7 years. And then when you start to think about, what do SaaS companies exit multiples look like at this point in time? What sort of a valuation could you possibly build? And if you have 30 or 40% of that left, it's a magnificent job done. You've built a fine company and everyone gets a piece as they go out the door.
Exactly. So you're trying to determine what's the end game, what's the size of the pie at the end, and work backwards from there. Yeah.
No, that's really good. It throws me down into 2 other questions. One is, you mentioned you adding value to the investee, to the company that you're working with. Yeah. And I suppose we might have a view that the investors are the VCs are the big bad guys coming in, but actually, how do you add value? What does that value look like from your perspective? You've decided to invest in a company and you're saying, we're going to not roll up our sleeves, but we're going to put in a kind of a touch in this company. What does that look like, or what does that mean? I
think the first point to kind of clarify is, it's not, when we make an investment, it's never the company on one side of the table and us on the other. We have to be aligned that we're going on the journey together as partners. Rather than, adversaries. Now, obviously, we have, as an institutional investor, there's certain things that we would need in an investment, to protect that investment. And they would be standard practice. But what we try to do with the companies and the founders that we work with is align with the companies and say, listen, okay, here's the gaps in the plan. Let's see what we can do to help fill that. So good examples are things that I've mentioned. Can we help you guys find a CEO who has experience in the space? Or if you already have your full management team, can we help you build out your board? We would typically take board and observer positions on the companies, particularly for companies where there's first-time founders that might have not gone on this journey before, and we would apply the benefit of the experiences that we've gained over several funding cycles and several dozen companies that we've invested in, and apply that value back into the company. So one of the benefits of a firm like Atlantic Bridge that has so much experience across multiple jurisdictions with dozens of different companies is most of the challenges we face, now we're always learning as well, but most of the challenges we face, we've seen some kind of shade of it before, and we can help the companies kind of navigate things through, navigate their way through those kind of challenges. So the value add is very significant. And it's very significant as well from a sectoral perspective, Conor. We have not just on our investment team, but we also have venture partners who might be experts in life sciences or in semiconductors, and we have a number of strategic advisors as well that also participate in both the diligence of the companies and the value add post diligence as well. So we've a very, very wide team that gets involved with the companies, and no matter which fund we've invested in, we generally portfolio companies that we have made investments in generally get the benefit of that whole Atlantic Bridge network, which we call the bridge model, and it's quite significant. And what we try to do is encourage the founders, especially of the early stage companies, over time to start to get to know the rest of the team here, and to develop those relationships themselves as well.
It's lovely because, one of the things in Dublin BIC we talk about is the ecosystem, and if you're a founder, early stage, like it's a different world, there's different language, different people, it's a new ecosystem. So having access to that, and as you talk about it, the bridge model, so you don't just meet Helen at the front door, but you kind of behind the scenes, there's a whole bunch of people that potentially you can talk to, which I think is a lovely phrase. Can I ask you, and you mentioned convertible loan notes, and just as a method of investing, Helen, so there's kind of your straightforward equity, there's the convertible loan note, and then there's SAFE, which is a CLN with a twist. Maybe just kind of talk about your preference and how you prefer to invest, and why would one go for equity or a CLN, or indeed go to SAFE?
We're definitely seeing more SAFEs come into the market. I think the NDRC their new mechanism is SAFE, and what that what allows companies to do is to take on maybe smaller amounts of investment in a very streamlined, highly replicable way. And you get the money in quick, and you get on with the business of building an early stage company and get on with that kind of validation side, which is fine. At the seed stage for seed rounds, typically we would see equity investing, Conor, where you're actually pricing investment rounds, and your full round, which might include ourselves and maybe some other syndicate partners, maybe EI and some privates. They're typically priced, okay? But in some cases, you will see convertible loan notes going in, and they may be in the case where it's just difficult to actually put a valuation on the company at that time. It could be very novel technology. It could be, in some cases, a high degree of risk in it, and you just want to get the capital in, get the plan going, start to de-risk in some respects, and allow another investor to come in when it's a little bit more de-risked to actually place that independent valuation on it. So I'd say I've seen both, but I've seen more on the equity side.
Right.
And that can often be sometimes cleaner, if you like, for companies as well.
And so in broad terms, then the advantage of equity is, or disadvantages, is that you're probably crystallizing a valuation at that point. On the other side of the CLNs, you're maybe kicking that down the road a little bit, which could potentially give you some issues further down the track, I guess. You're not trying to price the round. You may be pricing a discount to the round, but in fact, you're potentially pushing it down the road a little bit. Yeah, and in some cases, it can be a way of if you believe that your valuation is a lot more than maybe what you think, what other people think it to be at that time. It can be a good way to still get business done, to still actually get a transaction done, but to actually delay that kind of conversation about valuation. But in most cases, what we're trying to do is set, market terms on a company, apply a good kind of valuation methodology to a company, and that can be hard at seed. But you also don't want to get too far ahead of your skis on valuation either, because if things don't go according to plan at seed stage, which can happen quite often, it's loaded with risk, and you may need to bring on additional capital if you have delays on your milestones. And what you don't want to do is end up in a position where you're taking capital on later at a lower valuation and hitting a down round scenario. Yes. Okay. There's a couple of questions. So Michael has one from Seed Legals on around, the mistakes that startups make. Typically, how long does it take to move from that discussion to closing the deal? But to maybe describe the process of investment from the very first time when I meet you to what does that look like, and then what am I going to encounter along the way? Okay, but let's set aside the example of the person in the comm fund, because that journey with us can be over several years. But somebody coming fresh into to meet us, through a warm introduction or whatever, that has a reasonably good deck, that has a reasonably good story, and has a fairly well developed plan. And say, for example, that's a company that meets our needs, and we, like the founders and so on, we're interested in that technology. We can move through that investment process pretty quickly. We would start off with a very detailed diligence questionnaire, and what we would encourage companies to do if they feel that they are a fit for us. And I'd encourage companies to do that research first. To try to find companies in our portfolio or speak to our portfolio companies to see if they think that we're a fit for us, to do that homework first. And then once we get through that diligence perspective, to have all that documentation ready, okay, have a data room ready, have your information ready, and then give us time to come back with questions and try to respond to the questions correctly and in a well-developed way, to allow us to actually work through that and get comfortable with it. Then what we would do is advance the proposition to our investment committee, and one of our investment professionals would present the opportunity to investment committee, and then we would make a decision to invest or not, and what the terms of that investment might be. So that can take, I suppose, 6-8 weeks, depending on the company having everything ready. In most cases at startups, that's not the case, because there's always going to be gaps or questions that they haven't planned for. Or when I talked about that
that part of an investor looking for the extra bit or the something different, that's normally is determined based on the questions that are asked. Now at Atlantic Bridge, we do go through quite a significant diligence process, because we try to bring in as much value from the rest of our wider team as well into that process. And that can take a little bit of time on our side too. But we understand that companies want to get funded. We understand that they're trying to build syndicates as well. And we often lead the investment rounds, and that term sheet then can trigger others to come in. So we do, if we're very interested in a company, we try to move through that process as quickly as we can, depending on how flexible the company can be with getting us information too.
So, at its most simple step, that could be an 8-week process, to kind of reach approval from your investment committee. But then, you've got your closing, you've got your contracts and your shareholder subscription agreements and blah, 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 blah. So, if somebody is coming to you and raising a round in kind of Q1 next year, they're starting now with a view to kind of closing that round in, give it 6 months between the jigs and the reels and solicitors taking time to turn a document and whatnot. So,
yeah, they say it always takes longer than you expect. Now, I have equally, I've seen and I have, completed investments in a much quicker space of time, because the company was, I suppose, investor ready. They had all the questions answered. They could give us the information quickly. The round was coming together quickly. And maybe once we issued a term sheet, the work was done in terms of everybody coming together quickly enough that there wasn't a huge amount of negotiation. And when it came through the legal process, either it was pretty simple, and our documents are pretty well understood, their market, and we just moved through that process quickly enough. So on the legal side of things, I would certainly encourage the audience, to pick their legal counsel well, pick legal counsel that understands the venture process. That can really help streamline things as well. And the goal then is to, is to get to those finalized legal documents and get all the business of that out of the way. So once the monies are transferred, that you can get on with the business of building the company.
Very good. So I suppose to Eamon's question then, and Larry's, having a data room within there where you've got all the relevant contracts, financial models, constitution of the company, legal documents set up, all of that is really, really important. What are the no-nos when you're going through due diligence? Because it's interesting to dig a little bit on Eamon's one there to say, what actually would be a showstopper? Can you think of an example where you said, actually, we were working our way through and this just popped up as a big red flag?
Oh, that's a big question. In some cases, I don't know if we've ever found something where it hasn't stopped us. It might delay things rather than us not actually doing something. But, if you're positioning something, I would say make sure it's accurate, okay, and that you're not maybe positioning things that to be ahead of things, especially we would do a lot of customer calls, for example, okay. And as part of our diligence, we might reach out to, you may not have customers, by the way, so we reach out to people that you might have been doing proof of concepts with, or folks in the market that might have a familiarity with you as a founder or worked with you in the past. So we'd start to do that kind of reference checking or checking things. So will those third parties that we'd call, would everything that they'd say stack up against what you have told us as a founder? And sometimes you can find there's a difference there, So somebody say, we have a customer, and you might have nearly that customer, but yet the contracts mightn't be signed and stuff. So I guess it's to be as truthful as you can, but also you're trying to sell as well. But to make sure that those validation calls stack up. I think most of the times where things crop up is in that validation phase when we're trying to do our diligence work and verify things.
Yeah, I'm reminded of, for me, looking at it from the outside, Helen, the sales pipeline is always the one that I jump to, particularly if they're pre-revenue, and I've spent a bit of time building up. And I'm reminded of working with a client years ago who kind of claimed to have this contract in China that was underpinning the entire sales pipeline. And the investor reached out to the client, and the client said, not us, we're not spending that amount of money or anything like it. And the deal collapsed. So I think you do have to be, and we're all sales guys, I think you have to be optimistic, but you have to be realistic. And, if you're putting forward a customer saying there's a dollar amount against that, well, the customer very much has to be in sync with that, I would think.
Yeah, and I think on the technical side as well, if your claims around your technology are that it's X times better and Y times faster, and that you have, data points to prove that your your publications or your, you know, your benchmark data and your validation around that is actually there and it's real. And so things like that that help us kind of make an assessment of the validity of what you're saying is going to be really important.
Okay, good. So I hope that answers the questions from the guys there. Just go back to SAFE, if you wouldn't mind, Helen. Fergal had a specific question. Is SAFE compatible with EIIS? Do you know? It's a very specific.
I believe it is.
Yeah.
I believe it is. Yes, I don't think it isn't. And the reason I say that is that I would be surprised if NDRC were going out with safe notes if angel investors would be excluded from co-investing. So I'm sure there's kind of mechanisms that allow that to happen, but I would be surprised if it wasn't compatible.
Very good. Can I ask you, what is hot right now? When you're looking at opportunities, when you're looking at the world around us, we're coming, hopefully, to the beginning of the end or the end of the beginning of the pandemic, depending on your point of view, but we're coming out the other side, hopefully. It will move to be endemic, I guess, and stay with us. But the world has dramatically shifted over the last 18 months. There's been, you know, you take a platform like Hopin, which has gone from nothing to a multi-billion-dollar company in the space of 2 years. So two questions, or a two-parter. What, in your view, how has the world changed? And then what does that mean in terms of the opportunities, sectorally broad, that you're tracking?
So as predominantly technology investors, you know, we're increasingly more interested in the technologies that impact things like health, climate, the future of work, transportation, a huge amount of sensor work, you know, and the ubiquitous use of technologies and the sensors that are required for that, be it in cameras or in audio or in speech and so on. So, and then on the climate side of things, you know, carbon technologies are going to become more interesting. Quantum is, as I mentioned earlier on, is huge. Med devices that are taking away surgical, any kind of surgical intervention. So minimally invasive devices. On the biotech side, then, you know, we're seeing the, you know, that incredible, we shouldn't forget, you know, the incredible rollout of vaccines over the last 12 months. Immunology, we're seeing that now. I think that's going to be post-COVID an increasing area of venture investment as well. So there's a broad kind of church, if you like, of different technology, of different opportunities, but it's the underlying technologies that we're particularly interested in. Power management as well, Conor, that's going to be huge. You know, from a climate perspective as well. So I think the sway of technologies is vast, but I think those that kind of can tackle some of those, you know, the post-COVID market in terms of healthcare and climate and future work are particularly interesting.
And it's interesting, you know, you talk about there's an underlying or a technology, and then there's kind of specific use cases that are coming out of that kind of are interesting. And Arnold has a question there, which is interesting. So he kind of says, you know, says SaaS or cloud computing, you know, even AI, it's kind of becoming more mainstream. So then if somebody comes to you and says, well, I've got a SaaS company, you go, yeah, that's great. It's actually going to be a SaaS company that's come up with a novel way of addressing a problem that hasn't already been addressed, I guess, is it. As opposed to, we're a SaaS company and we talk like this.
We're like, we would invest a lot. It was remiss of me not to mention things like, you know, security and cybersecurity and so on, and we're looking at a lot of AI chips, so system on chips and AI technologies that are actually on chip as well. So and we see there's huge amount of opportunity then in data centers and how we actually manage and roll out any kind of software platform, but on the data center side of things as well. So if you follow the whole kind of chain through, you can see what I mean, maybe more about the underlying technologies pointed at these particular market opportunities and like broad market opportunities.
So is a better way to look at it, rather than I have a piece of technology that's SaaS or it's this or that, I have a piece of technology, but it's pointed at a particular issue that needs to be resolved. And here's how I do it. And here's how I do it differently. And that's kind of the pitch.
And here's how I build value in that, right? Along that journey. Here's how I create value.
Right. Okay. Yeah. Value for within the value chain, but also for the company itself and for the investors. Got it. Just a small kind of operational question. Are the DD legal costs the responsibility of the startup, and is there a rough figure on these costs? Well, how long is a piece of string? But I guess in the answer there is that the startups will pay for legal costs out of the round that's raised, if I'm not mistaken, Helen.
Exactly. The startups, the legal costs come out of the round, and those legal costs are generally capped at a certain amount. So it's agreed. It's agreed what those numbers would look like. So
the advice to you, Anna, if you are going down this route and you are entering into a kind of a process with an advisor, whoever he or she may be or they may be, it's really important not to sign an open-ended check whereby every call there's 10 people trying. You've got to cap those costs and say, look, to develop a shareholder agreement or to develop a due diligence process, there's a fixed fee, and that encompasses everything. That gives you some comfort around it, as opposed to kind of letting it just drift and drift and drift.
Yeah, get quotes from a few different legal outfits, compare them, see if they're market, and then make your selection.
Yeah. Really interesting question from Andrew here. What's the typical profile of a later stage enterprise company looking for growth? What do they look like? So whether that's ARR or market size or growth, I suppose, how do you value probably that Series A opportunity from an investment perspective?
So, I mean, you could look at metrics like ARR. You could look at things like, have they recurring revenue in the multiples of millions? But equally, you could look at a very, very deep technology that could still be pre-revenue. And here I'm talking about semiconductor, because you may be very far out from customers, our revenues at that point. But what we would be looking for is design wins that you have contracted to actually supply your technology into with a third party. So you're in their design win. So it can be different, but essentially what we're looking for there at growth is product market fit, that has been established. At seed, it's almost like the experiment in the seed round is to go and find signals for product market fit and to see if the validation for the market can be de-risked. But at growth, it's that there is established product market fit, either with contracted customers or in the case of deep technologies where it's again, medtech is a good example of this. They may not be contracting customers, but it could be through its large clinical trial and getting ready to go into the market. So there's different kind of timelines for different sectors, and because we're multiple sectors, there's not one size fits all there. But I would categorize it into: have you de-risked, have you product market fit, versus seed, that you're trying to establish what that might look like.
Kind of the difference between the proving money, which is the early stage money, and the scaling money, which is the next bit. And you're scaling against a couple of key metrics that probably the company has to bring forward to say, this is what we're doing, this is here's how we've proven it, here's our pipeline, here's what revenue looks like, here's a growth curve on revenue, here's the type of team we want to build. Yeah. James has just popped on and has asked us about blockchain. We made it 45 minutes through without a blockchain. What's your sense on that whole kind of world?
It's really interesting, and one of my earlier roles, I worked in Japan many years ago, and I worked with a software company called Digital Fashion, and we were designing software for fashion designers. I was reading over the weekend, NFTs, and you're buying virtual fashion online for thousands and thousands, and all this kind of stuff. And I think it's really interesting, the things that are now being bought kind of in a virtual world and value being created virtually. But a lot of that is now possible because of blockchain technologies. So I think what we're now seeing is kind of an establishment of blockchain creating value in what we might think to be kind of maybe in some cases bizarre opportunities, but without that underlying technology in place and that being further de-risked, those kind of things wouldn't be able to happen. But listen, I think there's a huge amount of risk still in that space, I would be cautious about kind of investment in that space. Not saying we wouldn't do it, but I think it's difficult to kind of validate some aspects of that kind of.
It's probably just, blockchain as an underlying technology is going to have its time. There is no doubt about that. We've probably just been a little bit with Bitcoin and other kind of cryptocurrencies at the front end and the get rich quick schemes are probably overshadowing actually the powerful nature of blockchain and what it will do for us into the future. infrastructure.
Yeah.
And there is then that kind of, we need to get by the first gold rush phase, and then we'll settle down into a technology that has a core part and will be around, I believe.
Yeah, and I think we're beginning to see things like that, and applications of blockchain in health, and data records around that are kind of interesting, kind of more tangible applications. I think that could be high value.
Yeah. I have a question from James, and if I think I understand it, you're developing a facial recognition payment system, and you're trying to get recognized by people who don't understand the business, and then maybe your technology is at such an early stage. How, I suppose the question, Helen, is how does one, is there a point in time where startups have to educate investors as to the platform or the technology?
Yeah, I think my answer to James would be to try to build a network around him that helps validate what he believes to be true and what he believes is correct. And, you know, in some cases that could be advisors or people in the commercial world who validate, verbally, I guess, validates that what he is saying or suggesting is actually correct, just to help with that validation point. If it's that novel that he can't find a set of investors that don't understand it. Now, I would, you know, in most cases, even if the technologies are very, very nascent, we certainly would have a large bench of people that we could turn to and get validation on, either in academic settings or, you know, through our own networks, or, you know, within our portfolio companies in some cases as well, you know, to try to help us better understand a technology that could be very, very novel.
Perfect, thank you. I've time for two more questions, and then I'm going to let you go, Helen. There's a really interesting one there, which is around future of work, which is this growth area post-pandemic. And the question from Hugh is, you know, will the focus be on software and platforms or on broader future of work? Probably a bit of both, really, I guess, Helen, is it?
I think it's going to be both. I think you know, it's fundamental, you know, especially like in large tech and in large corporates, there's going to be a huge amount of opportunity there to better and more efficiently manage blended working, hybrid working, and all sorts of different aspects of inclusion, I guess now, diversity, well-being, healthcare, but also getting work done efficiently as well, and remotely, and team construction and collaborative environments and so on. So it's a very busy space, actually. There's a lot of companies that we would have looked at over the last number of years that were trying to get into that market, and some have been doing some early validation in it. And I guess now is their time to really kind of shine in that space. You know, if they're not going to win business with the market conditions the way they are, you might have some questions. But a really interesting space to work on. Busy, but you know, so if you have a differentiated angle there, I think you might be able to create a lot of value.
Yeah. And last one from the floor, and then I just want to close this off, Helen, is from Raymond. You know, validating your model in your test bed, research markets, is high-level research enough? I suppose his question, I think, talks to a little bit about how do I convince you that somebody wants what I have, and how might I best go about that?
Doing something in a test bed environment, you know, there's inherent risk in trying to translate that into a commercial environment. And what we have to do is try to make an assessment on, you know, how you're going to actually do that. And in some cases, we may say, okay, we want to see this in a commercial environment first. Or in other cases, we may say, okay, here's the plan by which you may get that validation commercially. But we would have made an assessment of the risk that of what that journey looks like. So again, it depends on the technologies and so on that we may invest in. But there's, you know, things that work in a lab don't often work in commercial land. So you've got to kind of understand how you can better make them work, or what the plan is around that to actually get those technologies into market.
Very good. Can I ask you to close us off, Helen, to summarize, for the startups on the call who want to come and talk to you, what do they have to do to get your attention? What's going to grab you and say, that's very interesting, let's meet these chaps and have a chat with her or him?
I think there's a number of different ways in which anybody on the call can make contact with us, this through our website or through an introduction. And what I would say is that referrals, and Conor, you'll know this, yeah. And I'm sure you advise people to do this all the time, referrals in VC are gold. Try to find somebody to get you a referral in. You can just even see from the number of companies on the call and the number of founders on the call that we have a very vibrant ecosystem here. We have, many startups looking for funding. We have a number of seed funds in operation. We could probably do with more. We need more capital in the market to actually serve the market in the right way. So it is quite competitive, and there's limitations on funds as well in terms of their ability to fund, a select number of companies. We would make about, I suppose, 6 or 7 investments a year from the seed fund alone, but yet we would see hundreds of applications and hundreds of founders during each year. So there is that process and that funnel, but you need to have a very compelling story.
So the story has to be compelling. It talks about the what is the opportunity? And Noel had a question there, which we didn't pick up, but I did think we did get to it earlier on, which was about, will you invest in a single founder? Probably not. There's a really good team. You're able to demonstrate there's a really good opportunity. And the other thing Helen mentioned, if I pick it up here, was something different. And I think how do you convince Helen and the team that there's something different? Because I presume if you're looking at, I don't know, hundreds of pitches a year on a pipeline, and you're ultimately going to come down to 6 or 7 investments in a year, it's really what's that magical piece of secret sauce that's going to stand out to get your attention?
You've summed it up much better than I have, Conor.
To all of our participants who joined us, thanks so much for coming on. I hope you enjoyed it. Helen is open to contacting, but actually I love that point about the warm referral and finding ways into you, whether through Dublin BIC or through the other people in the ecosystem who could do a bit of work with a startup to kind of look over what it is you're sending in and make sure that you're prepared when you're going into the team. It kind of gives you, and then be very, very clear on what is that significant point of difference such that you can get attention from the team.
Exactly, Conor.
Thanks so much to Dr. Helen McBreen of Atlantic Bridge. Thank you for joining us. Pleasure to have you, and we'll see you soon. And to all of our attendees, thank you so much. Have a great day.
Thank you. Bye-bye.